mutual funds got class. They really do have class. There's different classes in mutual funds. So mutual funds do have a bit of class. We're going back to the impact of the fees and the aspect. We used the Schwab example earlier. You can kind of see what's going on with this. And now we're going to look at the way that you handle the expenses that you have. So the actual load over here, you'll see we have, for this example, the original 20.91, $20.91. Year one returns 5, year 2 is 10, year 3 is a -6. That is kind of life sometimes with mutual funds. So you can see the shares purchase, and then you see the actual expense. Okay, the second column is the no load, which has a high expense, and then you have a low load with a low expense. 3 different ways to actually purchase it. You'll see the one that actually calculates with the highest, with the actual expense, actually earns more over the same period of time as the other two. The no load, yes, you need to buy a no load over there. I don't think it's always a bargain. And to be honest, I shy away from no loads because I simply don't trust the fact that there's always something involved with that. And yes, they tell you the load up front. The low load and the actual load, those are my 2 preferred ways of buying mutual funds. I really think it's a good investment. Either way, generally, for the most part, my experience has been positive, and hopefully yours would be too if you use this as part of your portfolio. But we're covering a whole range of different tools to use. This is just one instrument on the fees. So you got to pay attention to the fee when they start tossing the jargon at you, and you get this whole pamphlet, and it's 35 to 45 pages long, and they want you to read the whole thing because you understand this process over here and you agreed to. Oh my gosh, it is incredible because they print these things in 6-pitch font, and you're supposed to understand the whole aspect of it. Part of it is they like to sit down and go through. I encourage you to read a prospectus on a mutual fund once. It'll actually change your whole perspective of the English language by the time you're done. Here you have different classes: Class A shares, B shares, and C shares. If you hold shares for many years, okay, the Class A shares provide a much better return overall. And that's why you end up buying those, and a lot of people roll into that. There's no back-end fees. Okay, and you have the different aspects of the fees. They're all lower, especially on your annual fees. And the B shares are higher, and the C shares the same thing. So pay attention to what you're getting in the process. I have a preference always to the Class A shares, but that's just me because I prefer to have the work done for me instead of having to watch it on a regular basis. The investment type is a really very specific thing. What do you want to have your fund? Do you want to invest in stocks, bonds? That's a big difference between the two, because keep in mind, we talk about investment, you tend to have this market that stocks go up and bonds go down, bonds go up and stocks go down, except for the fact we've experienced a couple strange things in the last 5 years. We actually recently just had them both going up. That is not supposed to happen, but it does. I'm not certain what's going on in the market, but be cautious on trying to do any general assumptions because markets change, and sometimes in the economic consequences of recovering from the pandemic, that may take years in the process, but also you have the strange inflation in the process. You'll see that as well, and people trying to manipulate the funds to make more money on the market for whichever way they possibly do. So the investment type is a big thing. I always recommend the more diversity, the better of your investment type. And the investment style, usually you'll get the fund manager telling you what their style and their strategy is. Sometimes it's pretty detailed. And quite frankly, if you ever want to have some interesting reading, read one of the prospectus on the fund, and it'll put you to sleep right away. Except for the fact when you come to the style and strategy, that's going to impact you as to the growth or value of it. And so you want to pay attention to this one. You'll have multiple paragraphs of the style and what the focus of the fund is. You'll have that. And sometimes you'll have the history of the actual fund manager, which really will help you understand where they're coming from. But they change on a regular basis as well. So watch what's going on there. Types of mutual fund portfolios, you have money market funds. They really focus on cash reserves and short-term IOUs. You have bond funds where they invest on fixed income, which is a much more stable mutual fund or debt instruments. And then you got to pay attention to the aspects that you would normally for a bond, like the maturity, the credit risk, and the yields. So pay attention to what you're doing, especially if you're going to a bond fund. It's kind of interesting. Bonds are much more stable than stocks generally, but you can never make any solid rules in the financial marketplace, because out there's people that want to be the winner. And if you're the loser, they don't really care, because they're making money upon your demise in the process. Stock funds, they invest a lot of in equity securities. You want to have that. They have a higher risk than other types of mutual funds, especially bonds, but there's different strategies. Sometimes you want to invest in a mutual fund that is an income fund. And often in the actual title of the fund, it will tell you what it's focusing. Income fund, and also you're drawn to it because income funds, you have high dividends, and that's what they're investing in. The growth funds, where it focuses not so much on the dividend, but on the fund overall growing in value. That's a really smart move. And then really is you want to have a large capitalization or a small capitalization. So a large capitalization, gigantic corporations, or small for smaller corporations, or a blend thereof. And you can mix these things up as much as you possibly want in your same portfolio. Here's kind of a box that'll help you if you want to use it. You look as to what you're out there. What kind of, do you want to have a large capitalization, mid or small capitalization? And then are you going to go for value or growth in the process? You're going to go for something that's going to provide high dividends, or do you want or high growth, or do you want to have something that blends them both? There are funds that do that on a regular basis. So pay attention to what your focus is and what you want. I always recommend the more financial diversity, usually the better strategy. But here are some different things, and you can still mix and match it. The contrarian, I think the whole world is going downhill, downhill, downhill. I'm going to vote contrarian with my money in my special. There are funds that focus on short positions in mutual funds. It's kind of interesting. I've always watched them from a distance, not wanting to get involved with the whole thing of that negative attitude and the energy. But sometimes the contrary ones work really well. You're buying and holding rising securities. You're looking for growth aspects of it. That's a specific strategy, and that may be yours. You may want to have stocks in all 5 of these aspects of it. The market timing, where you buy them when it's low and sell them when they're high, okay? Or the sector rotation, look at different sectors and see what's going down. You go into the tech sector over here, go into land sectors over here. There's sectors for just about every single aspect out there in mutual funds. And then look at the life cycle. But keep it in equity, let it grow, grow, grow. And then as you get closer to retirement age, you sit there and focus these on debt for stability and high return. So it depends on what you want to have, and you can mix and match these as much as you want to. Some of these specialized funds, I particularly enjoy the index funds, the S&P 500 funds. They're really good. The NASDAQ is good if you're a techie person and want to follow the tech stock. You have now a new brand out there. We call them ESGs. It really looks at the environmental, social governance out there. And you'll see, in essence, that when I teach international business, we talk about having multiple bottom lines as to whether or not you have profitability, but also the response that companies are having on the environment or social or the governance in the process. So you have multiple different bottom lines for corporation. There's some aspects of it. Some people think that the ESG is dying. I think you need to pay attention to it, because overall you have a big push worldwide for this. But the reality is that the ESG funds, some people are drawn to that aspect of it, and you have an opportunity for that as well. Know your terms, look at your strategies that are out there. Look at the 5. I think the 5 are really good to pay attention to, but just, mutual funds always got class. Take care.